Welcome to the deep dive. We take a stack of sources and pull out the key insights so you can stay informed without drowning in information. And if you've been keeping an eye on things, you know Q1 FY26 has been, well, let's just say turbulent. We're seeing everything from actual military actions to cyber and trade conflicts bubbling up. It's creating a lot of market volatility, making businesses a bit nervous.
Yeah, that's putting it mildly. I mean, these global tensions, both political and economic, they're creating a really complex environment. Businesses are definitely being tested.
Yeah, absolutely. But amidst all that global noise, India's story is quite different, isn't it? It's emerging as sort of a relative bright spot, showing some real macroeconomic stability, good signs in GST collections, rural wages are up, and the government's really pushing capital expenditure.
It's fascinating, really. India seems to have managed to create its own more favorable macro conditions, almost shielding itself from some of the worst global headwinds. And that provides a pretty solid foundation for key industries like the wire and cable sector we're looking at today.
Exactly. And that solid foundation is why we're diving deep into Ddev Plastiks Industries Limited's Q1 FY26 earnings call today. Our mission, as always, is to pull out the crucial insights, their business segments, the industry outlook, where they see future growth, and importantly, how they're managing risks in this pretty dynamic world.
So, okay, let's unpack this. How Ddev Plastiks is navigating this storm and actually charting a pretty ambitious path forward.
It's a really interesting case study in how companies respond strategically. Take the government and the RBI, for instance. They've been quite agile. We saw 100 basis points. That's a full % cut in the repo rate this year. That's the rate banks borrow from the RBI, so it makes lending cheaper.
Right, stimulating activity.
Exactly. And alongside that, a 150 basis point reduction in the CRR, the cash reserve ratio, that frees up bank capital, injecting more liquidity.
So cheaper and easier lending, were there other levers they pulled to keep the money flowing? Oh, definitely. Beyond rates, the RBI used open market operations, basically buying and selling government bonds to manage money supply and forex swaps too, plus various regulatory reliefs. This is a pretty comprehensive package.
And it wasn't just the RBI, right? The government's budget, the FY26 union budget, also played a big role.
A huge role. It was clearly pro-growth. They put in INR 1 trillion in income tax relief. That's aimed squarely at boosting consumer spending. Putting money back in people's pockets.
Right, direct stimulus.
Precisely. And then, on top of that, the government got this record dividend from the RBI INR 2.7 trillion that gives them massive fiscal flexibility. It means they can fund growth initiatives for the rest of the year without necessarily borrowing more. It's quite a powerful combination of monetary and fiscal action working together.
So all this extra flexibility allowed the government to really boost its own investments. What kind of scale are we talking about for capital expenditure?
We saw a significant ramp up. After maybe a slower start in the first 9 months of FY25, March 2025 alone saw a huge outlay, INR 2.4 trillion. And looking at January to May 2025, capital spending was up 41% compared to the year before. That kind of government investment is a major tailwind, especially for infrastructure-linked sectors.
And that brings us nicely to the wire and cable industry. It's fundamental to India's expansion, isn't it? Projected growth is around 12% CAGR.
That's right. And that kind of growth projection means big investments from manufacturers. We're looking at something like INR 13,200 crores in planned capex from the leading players.
13,000 crores, that's a huge amount. And that's where Ddev Plastiks comes in, supplying the essential polymer compounds, right? The stuff the cables are made from.
Exactly. They're a critical link in that value chain.
But making these compounds isn't simple, is it? You mentioned high barriers to entry. Why is that? What makes it so specialized?
It's definitely not a commodity game. The quality demands are incredibly high. Think about it. These compounds insulate electrical wires, sometimes carrying very high voltages. Safety is paramount. So you need to meet really strict quality specs, get approvals from end users like power companies, have robust quality control systems, and invest continuously in R&D. It takes significant expertise and ongoing capital investment.
Okay, so it requires deep technical know-how. That sounds like a strong position for an established player like Ddev Plastiks, especially being the largest listed one in India. So when big new players like Adani or Ultratech enter the wire and cable market, does that mean more competition for Ddev, or do they actually benefit?
That's a great point. It actually works in Ddev's favor. These large companies entering the cable manufacturing space, they need reliable, high-quality compound suppliers. They aren't likely to start making compounds themselves initially. Given Ddev's scale, reputation, and proven track record, they naturally become a preferred supplier. So new entrants actually expand the market for DDEV's products.
Interesting. So DDEV isn't just riding the wave, they've kind of built the surfboard, as the saying goes. Their expertise is key for these new giants, which leads us to the crucial question. How did this strong positioning translate into their Q1 FY26 performance? Did the numbers back up this strategy?
They certainly seem to. Revenue from operations hit about INR 769 crores. That's up 23% year on year.
Solid growth. What drove that?
Primarily strong demand from that wire and cable sector we talked about, but also better pricing. Their average selling price increased by about 50 basis points or 0.5%, hitting INR 108 per kilo. That's up 9% from Q1 last year.
Okay, so volume and price both contributing. What about the bottom line, profitability?
Also quite healthy. EBITDA came in at INR 79 crores, which is a 10% margin. Profit after tax was around INR 52 crores, a 7% margin. And importantly, the volume growth underneath that was really strong, up almost 30% compared to Q1 FY25. Production hit nearly 52,000 tons, up 11% year on year, and capacity utilization improved nicely to 87%. Pretty impressive given the global backdrop.
Definitely impressive numbers. Okay, let's drill down into the specific business segments. First up, XLP compounds, cross-linked polyethylene. These are for higher voltage applications, right?
Correct. Crucial for medium and high voltage cables.
They have about a third of the market share now for 11 kV to 66 kV. But their goal is much bigger, over 50% share up to 132 kV. What's the strategy there moving into higher voltages?
It's a very strategic move. Currently, they supply up to 72 kV. The expansion plans aren't just about more XLP, but higher spec XLP. They're aiming to get into the 220 kV segment eventually, with certification for 132 kV targeted for late FY26 or early FY27.
Okay.
Now, getting big volumes specifically from 132 kV might take a bit longer, maybe post FY27, because building trust at those levels takes time. But getting that 132 kV certification is huge. It validates their technical capability across the board, even for the lower voltage products. It builds immense credibility.
Ah, I see. So it's a bit of a halo effect. Succeeding at the top end boosts confidence in everything else. And is there a good market opportunity in those higher voltage ranges?
Yes, absolutely. The 132 kV to 440 kV market might be smaller overall, maybe 10–12% of the total XLP insulation market currently, but the price realizations are significantly better, like 10–12% higher than for a 72 kV product. And DDEV is investing heavily here. They're planning around 60,000 tons of new XLP capacity in the next year, year and a half, and maybe another 24,000 tons over the next 3 years.
Wow, that's nearly 85,000 tons of new XLP capacity planned. That's a massive statement, isn't it? What does that tell us about their long-term ambitions in these high-value segments?
It tells us they're aiming for clear market leadership. They're not just meeting current demand. They're anticipating the future needs of India's grid modernization and the growth in high-voltage transmission. It signals huge confidence in their R&D, their manufacturing prowess, and their ability to capture the lion's share of this demanding market. They're essentially locking in their position.
A very clear strategy. Okay, let's shift to PVC compounds polyvinyl chloride. Margins there are currently lower, around 4–5%, but they expect improvement to 7–8%. What's the key driver for that?
The main driver is those big players, Ultratech and Adani, entering the building wire segment. That's a huge market that needs reliable, quality PVC compounds. DDEV already has strong brand recognition and a solid track record here, so they're perfectly placed to supply these major new customers. They've already added 5,000 tons of PVC capacity in the East coming online soon, with another 25,000 tons planned this year, maybe even more later.
Got it. And the third key area, HFR compounds halogen-free flame retardant. These are expected to get more industry impetus. Why is that?
The big push is coming from solar power. Solar cables need HFR compounds because they offer better weather resistance, UV stability, and critically flame retardancy for safety. And the solar market is just exploding. The demand for these compounds is projected to go from maybe 25,000 tons a year now to potentially 100,000 tons a year by 2030.
A 4- or 5-fold increase in demand? That's huge. How is DDEV positioning itself for that HFR growth?
They're moving fast. They have 5,000 tons of capacity now. Another 5,000 should be running commercially by November, so Q2 FY26. The goal is to reach 20,000 tons by FY27. And the margins here are attractive, expected to be above 15%. So you see how these expansions in XLP, PVC, and HFR all tie into India's big picture themes. Infrastructure, renewables, urbanization. It really future-proofs their demand.
It certainly seems like a cohesive plan. Across all three, you said over 130,000 tons of new capacity in the next 3 years, targeting high utilization rates above 75–80%. That's significant expansion.
It really is. Which brings us to their future outlook and, the risks they need to manage. They're targeting pretty ambitious long-term volume growth of 10-15%, leading to revenue growth of maybe 12-13%. The big goal is hitting INR 4,500 to 5,000 crores in revenue by FY30.
While maintaining that 10-12% EBITDA margin. And they have a specific target for EBITDA per ton too, right? Pushing it up from around 15,300 rupees now towards 15-16 rupees per kilogram.
That's the goal, focusing on value addition. And crucially, they plan to fund the required capex over INR 300 crores in 3 years, mostly from internal accruals from their own profits. Plus, they have plenty of land already over 300 acres, so expansion shouldn't be held up by land acquisition issues.
Sounds financially prudent, but growth always comes with challenges. Geopolitics, for instance, impacted their exports in Q1. How did they handle that?
Yeah, that was a clear headwind. The global situation made it harder to push exports as planned, but they adapted well, redirecting products to meet the very strong demand within India itself. And even with those challenges, their export revenue still grew 3% year-on-year to INR 154 crores, showing some resilience there.
Okay, adaptability is key. What about the U.S. market specifically? There are those high tariffs, 50% on cables from India. That must hurt, directly or indirectly.
It's definitely a risk. It impacts direct sales and also sales to Indian customers who then export to the U.S. But Ddev has a smart mitigation strategy here. They're actively working on getting U.S. certifications for their compounds. They already have one, with 2 more expected in the next 5 or 6 months.
How does that help with tariffs?
Well, U.S. certification firstly makes their product globally recognized for quality. It might open direct U.S. opportunities down the line, but more immediately, it allows them to sell to manufacturers in other countries, say the UAE, for example. Those manufacturers can then potentially export finished cables to the U.S. under different trade rules or lower duty structures. It opens up alternative routes to that market.
Ah, clever. Bypassing the direct tariff barrier through global validation. What about raw material prices? Polymers can be volatile. How do they manage that risk?
They point out that Indian polymer prices depend a lot on local demand and supply, not just global crude prices. Their approach seems to be fairly direct. Small increases in raw material costs, like the 50 basis points they saw, are generally passed through to customers. This helps them protect their EBITDA per ton metric, insulating profitability from input cost swings to a large extent.
Makes sense. And finally, any localized impacts, like the monsoon season in Q2, does that affect things?
Yeah, typically Q2 sees a bit of a slowdown, particularly in construction-related demand due to the monsoon rains. Ddev expects volumes might be slightly lower, but they anticipate keeping margins at par with Q1, so they expect to manage through that seasonal dip effectively.
Okay, so putting it all together, it seems Ddev's approach to hitting growth targets while navigating these global and local risks involves strategic diversification into high-growth areas, leveraging strong domestic demand, and actively managing trade risks through things like certifications.
Absolutely. It really highlights how a focused, well-executed strategy in a specialized high-barrier industry can drive growth, even when the broader global picture is less certain. It's about building resilience right into the business model.
So what does this all mean for you, the learner, keen on understanding how businesses navigate these complex times?
I think it really shows that even in a turbulent world, focusing on essential high-growth niches, investing strategically in capacity and quality, and being proactive about risk management can pave the way for pretty significant long-term success.
And maybe a final thought for you to consider. Think about how this seemingly niche sector, polymer compounds, is actually a fundamental enabler for massive trends like infrastructure build-out, the green energy transition, and urbanization, not just in India, but globally. How crucial are these often overlooked foundational materials in creating the future we talk about? And what other hidden foundational industries might be quietly driving major economic shifts elsewhere? Something to chew on until our next deep dive.